All right, guys, let's start the next chapter, right? So now we are doing your chapter number 2, which is your governance, right? We are in your book number 2, which is credit risk. We're doing the second chapter of book number 2, which is your governance, right? And this has two modules. Module 1 is about governance and risk management. Module 2 is about your credit risk guidelines, right? That we'll try to understand. Okay. So first of all, let's get our basics in order, right? So when you talk about your governance, right? Why do we need governance inside your credit risk, right? Because credit risk is not just about your probability of default models or your loss given default estimates, your exposure default, your calculation, credit war. These are tools uh, that gives us a deeper governance question that who is allowed to take risk, who checks them, who approves them, who monitors them, who audits them, right? Without governance, even the best model kind of fail. This chapter is about your structure before your numbers. And this connect to your operation risk controls, the market risk limits, your liquidity risk, oversight and escalation, Basel regulations, pillar to governance expectations. So governance is the backbone of your all risk discipline, right? That we need to understand here, right? That is the core objective of this chapter. Okay, simple and straightforward chapter, not so difficult, guys. Just like the previous chapter. In fact, previous chapter we discussed a lot of things related to how the applicability is to the future chapters. Here it's more about the framework of the governance, right? So when you look at the governance and risk management, what you need to understand is that there are two topics. One is the effective governance and risk-taking process, and second is your three lines of your defense framework, right? So these are not just your theoretical ideas; these are regulatory expectations globally. There is a Basel Committee, there is a ECB, there is a Fed, there is a RBI, right? Every large financial institution is built around this structure. So we'll try to go deeper and deeper and understand it better. Okay. So let's dig deeper, guys. Okay. So we are looking at your effective governance and risk-taking process. So basically, we're trying to understand each of these points better way. So first is your effective governance provides a framework for achieving your objectives. So what are we saying here? That governance is not about your stopping of risk. It is about taking the right risk to achieve the strategy. For example, a bank wants to grow the SME lending. That means taking more credit risk. Governance ensures your risk appetite, which is defined, limits, which is set, proper approvals, monitoring your systems play. So governance is more about your control risk taking. This links directly to your risk appetite framework. Very, very important in FRM, the capital planning, the stress testing, the ICAP, right? Then we have superior risk management balances your what you say needs with your protection. This is again very important to understand because business wants revenue, business wants growth, business wants your market share, risk function wants stability, risk function wants your capital preservation, risk function wants your survival, right? So governance kind of ensure the balance. If business dominate, we can get the 2008 kind of crisis. If risk blocks everything, then there is no profitability. So FRM basically wants you to understand this kind of tension that there is a balance that has to maintain. Risk management is not about saying no, right? It is not about stopping something profitability. It is about saying yes, but at the right place, right structure, right limit. So that is why here we'll try to understand concepts like your RAROC, risk adjusted return on uh, then the economic capital, then pricing of credit risk, right? The CEO is ultimately responsible. What are we trying to say here? Because governance flows from the top, tone at the top matter. If the CEO encourage your excessive risk, incentivize your short-term bonus culture, then your risk framework kind of collapses. This connects to your compensation risk, your operational risk section, and the risk culture, which is a very examinable kind of concept, right? And then we need to understand the main processes that are involved in risk taking are right. So there is a, what do you say, main risk taking process. There are three stages in credit. One is your credit origination, one is the credit risk, one is the credit approval. Credit origination, when you talk, this is the business side, relationship manager, find your client, structure deal, propose your lending. You look at the example, a corporate banker proposes a 500 crore loan. That is, they are the first line of defense. They own the risk. This links to your exposure default. The exposure default starts here, loan structuring, covenant design. Then we have the credit risk assessment. Now the risk management kind of enters the picture. They assess the borrower financial, calculates your PD, estimate your LGD, do your stress testing, price your risk. This is where your FRM uh, technical knowledge kind of lives. There are structural models, there is reduced form model, there is a transition matrices, there is a credit scoring. This stage ensures that the risks are kind of identified, kind of measured, kind of priced, and we need a kind of credit approval, right? So governance become kind of formal here. The proposal goes to your trade committee, delegated to authority holder, depends on your exposure sizing, depends on your risk rating. This prevents your one person taking massive risk alone. This prevents your rogue lending. This connects to your limit system, your concentration risk, your large exposure framework, the Basel rules, etc. Right. So again, very very theoretical in nature, guys. Okay. Then we go into the next part, which is the 3 lines of defense framework. Again, this you have seen in the FRM part 1 also, right? This is one of the most testable governance concept. We try to simplify it. This is, first line, you understand that is like a business. They take risk, they own risk, manage day-to-day risk. Example is your lending team, your trading team, your investment team. So they are not your risk independent. They are kind of risk owners. If a loan default, first line kind of originated it, right? This connects to your credit portfolio management, trading your portfolio and loss volatility, your risk adjusted performance, etc. Right? Then we have your second line of defense. Second line of defense, when you talk about this, set your policies, define your risk appetite, monitor your exposure, oversees your first line. Example is your enterprise risk management, your credit risk team, your compliance, your legal. They do not take a risk, they challenge and kind of monitor. This is where your model validation comes. This is where your stress testing comes. This is your limit monitoring comes. This is where your ICAP comes. They provide your oversight of your first line, all kind of live. This is critical in the exam. Then we have your third line. Third line we talk about, they are kind of independent. They review both first and second line. They test controls, report to your board audit committees. They do not manage your risk. They assess whether risk framework kind of work. Think of them as the referees of the whole system. This connects to your operational risk failure, internal control breakdowns, your governance lapses, etc., etc. Right? Very theoretical, very easy. Okay. Now, let's do the question, guys. To ensure an adequate second line of defense, organizations should do what, right? So they should include the compliance and legal function in the risk oversight. True. Look primarily to business owners because they own and manage the risk. Not true. Ensure that the first line of defense has proper oversight of the second line. Not true. Ensure that the audit function provides an independent risk management tool. Not true. Like, I'll explain you why I'm saying this answer, right? Because, see, when we say to ensure an adequate second line of defense, organizations should include the compliance and risk legal function in the risk oversight, because second line includes your enterprise risk management. Second line includes your compliance. Second line includes your legal, right? So that is why A is right? Why option B is wrong? Because we are saying that look primarily to business owner. Business owners are not second line, right? These are your first line. When look at option C, ensure that the first line of defense has proper oversight of the second line. First line does not oversee the second line. It is the reverse. Second line oversee the first line, right? Then option D, when you look at ensure that the audit function provides an independent risk management role. Again, audit, the third line is not risk management. It is your independent assurance, right? So that is what we need to have, understand, right? So we try to connect the dots across your FRM part 2. This governance structure affects your credit risk, your loan approval process, your rating models, your concentration monitoring, your market risk, your your trading limits, your war monitoring, your stress scenarios, your operational risk, which is your control testing, fraud prevention, cultural incentive, liquidity risk, which is your asset liability committee governance, your funding limits, your contingency funding plans. You look at the Basel framework, the Pillar 2 supervisory review, the ICAP governance, your risk appetite statement. Without governance, models will fail, right? Without governance, the limits will be breached. Without governance, capital will be misallocated. Without governance, crisis occurs, right? So governance is the kind of skeleton. Risk models are the, the muscles, and the capital is kind of blood, right? Without skeleton, there is a collapse, right? So why FRM loves this topic or test this? Because senior risk management don't only build your models, they design the framework, they oversee the system, they interact with regulators. FRM part 2 is preparing you for a good risk management, or how a good risk manager thinks, not an analyst kind of thinking, right? So that is what they are doing. So that's why they are telling you to learn this. Okay. So this is what the answer is. Effective risk management control is based on 3 lines of defense. First is the business owner. Second is your enterprise risk management, compliance, and legal functions. And third line is internal and external auditors and audit committee. The second line provides the oversight on the first line. Okay, perfect, perfect, perfect. Right. Then we go into the second module, right? So first module is completed, very, very easy. Now we go into the second part, which is your credit risk guidelines, right? So now we are entering into the operating manual of your credit risk governance. Module 1 was something which explained the structure. Module 2 now explains how the structure actually functions in practice. We'll try to go slide by slide and try to understand better, right? So when you look at your module 2 credit risk guidelines, if you look at the topics carefully, right? This is not your modeling, this is not your probability of default, loss given default, or credit warning. This is how do we design the rule book that controls your credit risk in an institution, and you notice the flow, right? First, we talk about the principles, then we talk about the guidelines, then we talk about creation and approval, then we talk about maintenance and control, then the breaches, then the skills, then the limits, then the oversight, then the transaction parameters, then the credit committee, right? So this is your full life cycle of your credit governance. So module 1 was about your understanding of governance framework. Module 2 is about your architecture, right? Policy architecture, right? So that is what we are trying to understand here, right? So let's dig deeper and understand it more. Okay. Now we are looking at the key principles of governance. When you talk about the key principles of governance, there are 4 pillars here. Let's try to simplify. One is your guidelines, right? This means you cannot run a bank on your common sense. Everything must be written down. Why? Because credit risk creates your capital impact, your default risk, your regulatory exposure. Guidelines defines who approves what, under what condition, what documentation is required. And this part directly connects to your Basel Pillar 2, which is your supervisory review. This connects to your internal capital adequacy, which is your ICAP, your regulatory inspection. Without your written policy, regulator assume weak control. You need to understand the skills. When you talk about skills is what? Skills is what? Your authority. Authority must be given only to your competent people. You cannot allow the junior staff approving a large exposure, your sales-driven employee overriding your risk. This connects to your operational risk, which is human error, the model risk, incorrect interpretation, the risk culture. So FRM wants you to understand risk failure often happens due to your incompetence, not your bad models. And we need to look at your limits also. Limits are the heart of risk control. The types of limit, which is single obliger limit, your sector limit, your country limit, your rating-based limit, your large exposure limit, of the Basel limits connects directly to your credit concentration risk, your economic capital allocation, your stress testing. If no limits, portfolio becomes kind of fragile, right? Then we have an oversight, independence kind of matters. If the person taking the risk is also reviewing the risk, it kind of collapses, right? So oversight ensure first line is monitor, conflicts are controlled, policy breaches are escalated. This links back to your 3 line of defense, your board risk committee, and internal audit. Okay, so that is what we need to understand. And again, if you look at your guidelines, which are the credit policies, so we're trying to put across that how policies should look like. So policies must be clear, right? Again, very important point that avoid legal jargon, because if policies are too complex, employees will misinterpret them, controls will fall, regulators question the clarity. You need to have a good credit policy. It should be understandable to your business team, your risk team, your auditor, your regulator. You need to look at the content of the credit guidelines. Policy must cover your purpose. Why does the policy exist? To define your acceptable corporate lending standards. You should clearly highlight the methodology, how risk is assessed, your rating models, your probability of default methodologies, your collateral valuation approach, the stress testing assumption. And you link directly to your credit risk model, which is very technical from the FRM perspective, then IFRS 9 expected loss, the internal rating system. Then you look at the transaction approval flow, who approves at what level, based on what exposure size. This links to a delegation of authority matrices, credit committee structure. You look at your, what you say, new products and markets. Before entering your new geography, your new asset class, your structured product, there must be new product, what you say, approval process, right? When you kind of look at these things, right? So very clearly, you should have, this connects to your model risk, your operational risk, and your, what you say, or reputational risk, and the consequences of your breaches. If someone, let's say, about violates your policy, is there escalation, is there disciplinary action? This connects to your risk culture, your compensation risk, operation risk control. Then you look at your creation and approval. Policies are not random documents; they are sponsored by a CRO or CFO, approved by the board. Why board? Because this committee is a board level responsibility. This connects to your corporate governance. This connects to your Basel governance standard. This connects to your systematically important banks, right? SIBs, right? That we need to understand. And we need to understand the maintenance part also. CRO's office maintain policies. Very, very important insight. This is your natural tension between your business, which want flexibility, risk, which want control. So senior leadership must manage this conflict. This is your real world governance, which we need to keep in mind. Okay. So please understand that. And then we look at your creation and approval, right? Again, we go deeper into accountability. There's a risk protection role. Guidelines are not your paperwork. They are designed to protect your capital. Every policy must reduce your probability of your, what you say, catastrophic loss. This connects to your tail risk, to stress testing and extreme event analysis. Then you need to have a management accountability. Senior management is responsible. This prevents your blame shifting. This removes that model did it or analyst made error. Accountability flows upward. This connects to your risk governance failures in 2008, rogue trader events. Then we look at your executive sponsorship, best practices, CFO or CRO kind of sponsored. Why? Because CFO understand the capital impact, CRO understand the risk structure. This ensure policy is strategic. Then look at your board oversight. Board risk committee kind of approves. This ensure alignment with your risk appetite. Strategic consistency. This connects to your ICAP, your stress testing framework, your capital buffers. Then you have to have ongoing review. Policies must evolve. Why? Because since 2008, regulators have tightened. Stress scenarios have expanded, model risk have increased. This links directly to your Basel III reforms, your capital conservation buffer, your counter-cyclical buffer. Then you need to have a quality check and triggers also, right? After major loss event, policy must be reviewed. This is your event-driven governance. For example, if sector default, spike occurs, sector limit your review. This connect to your back testing. This connect to your model validation. This connect to your stress scenario recalibration. And then we need to look at your forward-looking risk. This is extremely, extremely examinable and exam testing. Policies must consider the low probability, high impact event. Examples like your negative interest rate, your oil price collapsing below zero, sovereign downgrade. This connect to your stress testing, your scenario analysis, your reverse stress testing. FRM loves this forward-looking concepts and they want to ask you in the exam. Okay. Once we have understood this, we go into maintenance and control. Now, when we talk about maintenance and control, what do we mean? So now we are trying to operationalize the governance, the CRO ownership. CRO owns your risk guidelines. This ensure independent form business, risk alignment. CRO is the second line of defense. Then we look at your expert authorship. Policies should not be written by junior staff. Why? Because they must understand the products deeply. They must foresee the risk consequences. This links to your structured credit risk, derivative exposure, complex off-balance sheet risk. Then we look at your conflict management, very, very real world concept. We look at businesses. Business say we will lose client if limit not kind of increase. Risk says exposure concentration too high. Senior management kind of resolve. This is your governance in action. Then we look at your periodic review. Post 2008 regulatory environment is kind of stricter. Regulator expect your documentation, your evidence, your version history, your change logs. This connects to your operational risk, your regulatory capital, your supervisory review. Then we look at your event-driven updates, which is your mergers lead to your portfolio changes, acquisition leads to your exposure concentration shift, policy must adapt. This connect to your credit portfolio management, your economic capital allocation. Then we look at your guidelines. Guidelines must include your purpose, your methodology, your approval flow, your new product handling, your review process, your breach consequences. This again like a governance life cycle, right? So overall, what you need to understand why this matters in FRM part 2, because this module basically connects to your credit risk modeling. Policies define which models are allowed, market risk, trading limits follow the same logic, right? Operational risk has a control testing, the breach handling, liquidity risk, funding limits and contingency planning, stress testing. When you look at your forward-looking risk requirement, ICAP, governance must protect your capital adequacy assessment. Overall, we need to have a conceptual understanding. Risk management has many layers. One is the model, which is the PD, LGD, EAD layer. Then we have limits, which is the quantitative method. Then we have governance, who controls everything. So FRM part 2 prepares you to think like a CRO or a head risk head of risk, right? Or a regulator or a board member, not just like an analyst, right? So that's what we need to understand here. Okay. Very, very theoretical topic, right? Then we look at a breach and non-compliance, right? When we look at breach and non-compliance, again, uh, now we are moving into the control mechanics of a credit governance. Up to now, we defined the policies, we saw who owns them, we saw how they're approved. Now we examine what happens when things go wrong, who approves that, how limits actually control your risk, right? So in your breach and non-compliant, very, very important to understand that, again, the idea is governance is not about preventing your all breaches. It's about designing your intelligent response system when breaches happen. So that's what is the first case. When you look at your rarity of breaches, if policies are designed properly, breaches should be rare, limits should be realistic, control should work pre-trade. If breaches happen daily, either limits are badly set, or monitoring is weak, or culture is poor. This connects to your risk appetite framework. Limit your calibration, or limit calibration and operational control testing. Then you have severe consequences. Means if you have intentional breach, there's a governance failures. Example: originator structure exposure to high risk, trader bypass to limit control, risk memo intentionally suppressed. The consequences are termination, regulatory action, reputation damage. This links to your rogue trading events, your operation risk losses, or conduct risk. FRM wants you to understand that governance without accountability kind of collapses. Then you look at your tolerance for natural breaches. Now, this is a little bit of subtle kind of topic, but very examinable or exam tested. Some breaches are not due to human error. For example, FX volatility increase your exposure value. Market movement pushes your derivative MTM above your limit. These are external risk-driven breaches. Governance should allow predefined carve-outs, meaning that policy anticipates such event, control tolerance bands are defined, no panic escalation required. This connects to your market risk volatility, exposure default, sensitivity, stress testing, right? Then you talk about your centralized exposure tracking. Centralized exposure tracking means that you cannot manage what you cannot measure, right? So centralized system aggregates your exposure, tracks your limits, monitor your utilization. This links directly to your counterparty credit risk, your large exposure rules, your portfolio aggregation models, credit metrics, etc. Then we have your pre-trade control. This is one of the strongest governance tools before transaction is executed. Systems check exposure. If limits exceed, trade blocked or flagged. This is your proactive control, not your reactive. This connects strongly to your market risk limit controls, your trading war limit frameworks, automated compliance monitoring that we need to understand. Okay. All right. So once we have understood this, we go to the next part, which is a practice question, right? The firm's risk management unit is updating their guidelines related to transaction approval and delegation. Risk managers are worried that even when transactions fall within your available credit limits, foreign exchange volatility may cause breaches in these limits. Which of the following guidelines, parameters must or would be most appropriate deal with this type of outcome? Again, I think I discussed in the notes also that problem here is the FX volatility causes the credit limit breach, right? The key insight we discussed in the notes also that breach is caused by external market movement, right? So best practice is to include the carve out in the guidelines because that's how it works, right? So a guideline should include a carve out for breaches that are due to FX volatility. Why not your B, C, D? Because if you look at B, right, breaches in the credit limit due to foreign exchange rate movement should be immediately escalated to the chief risk officer, right? Again, why not B? Because escalating every FX movement to CRO or board is operationally inefficient or overburdens your governance, so that goes away. Why not C? Because the trading guidelines should treat each brief in the credit limit as an error by the originator because currency movement should be anticipated. No, it is not an error, right? Because it is FX movements are not controllable, right? So this question tests your understanding of intelligent governance versus a rigid governance that we need to understand. Okay. All right. So this once we have done this, so this is what is the whole idea, right? The firm should include a carve out in the guidelines to allow for breaches of credit limits due to external factors, not within the control of the firm. It is not prudent to treat these breaches and originator. It is not necessary to escalate them if the guidelines include the carve out, right? So that is what we have here, right? So this is done. And okay, fine. Then we go into your what you say skills approval and delegation of authority. So now we move into who approves what. This is one of the most practical governance areas. The core principle here is that authority must match your skill, right? So again, right, what we need to understand is that authority must match your skill, right? You cannot allow junior analyst approving your high risk exposure, sales team overriding credit risk. Your delegation must be kind of structured, right? And if you look at delegated risk authority, board and senior management cannot approve everything. So approval authority flows downward. This creates your efficiency. This creates your scalability. This creates your control. This connect to your operational scalability, your internal control design. You need to have a business partnership mindset. Very important cultural concept. Risk is not your enemy of business. Risk management must understand the business model, price your risk correctly, facilitate your control growth. This links to your RA, ROC, or risk adjusted return, your capital allocation. There is an advisory role. Risk is usually not profit generating, it protects your capital. So risk gives your opinion, business executes within policy, this creates your tension. Governance manages this tension. There is a what you say, escalation and dissent. If risk kind of disagrees, they can write the formal dissent memo, escalate to credit committee. This is extremely important for documentation, regulatory protection, and legal defense. Then we have to have your relegation process, which is again a two-step process, right? Uh, Step one is about assigning a risk parameter. Each transaction has exposure, amount, credit rating, and tenor. This determines your risk level. Step two is about delegate your authority based on your risk. There's a low exposure plus your high credit quality, then the lower level of approval, high exposure, low rating, senior committee approval. This is a risk-based kind of scaling and risk-based approvals, right? So that is what we need to understand very, very clearly, right? So again, very theoretical in nature, right? So when you talk about your risk-based approvals here, uh, approval authority increases with your risk, your exposure, your tenor, your credit quality deterioration. This mirrors kind of your Basel capital, your economic capital allocation. So if you look at, uh, you know, the example which is given on the slide, right? This is what you have, right? So transaction is 110 million, exposure counterparty rated R4, right? Counterparty rated R4, 110 million transaction. From table, you see that R4, you see approval up to your 125, right? So allowed at the transaction committee level. So uh, the idea here is that we also need to see that the credit risk assessment unit must recommend if exposure is greater than 75. This shows that there is a layered kind of system, right? And risk committee review, the committee approval, this is a multi-level kind of governance that we need to understand. Okay. And that is what is discussed here as well, right? To be fair, senior management involvement, higher risk, longer tenure, lower credit quality transaction typically require approval from senior management. The approval process is commonly structured as a risk approval flow, clearly outlining how delegation escalate as the transaction risk increases. And this is what we are looking at. Okay. All right. Now, if we go ahead, right, which is your topic number 7, right, which is limits, right? So now we are moving into the core quantitative tool, limits, operationalize your risk appetite. You have definition of limits, limit define maximum loss the firm is willing to tolerate. You have to think in terms of your single name exposure, sector exposure, country exposure, rating exposure. Limits translate your risk appetite to the quantitative boundaries. You have a hierarchical allocation, firm-wide credit risk cap is 75 million, broken into industry cap, your counterparty cap, your business unit cap. This prevents your concentration risk, your sector clustering, your systemic vulnerability. This connects strongly to your credit portfolio risk, your correlation modeling, your guarantee adjustment. Then you look at your broad applicability. Absolute limits work well for simple loans, but difficult for your derivatives, your long-dated structured products, your commodities. Why? Because your exposure changes over time, EAD volatility. This links to your counterparty credit risk, which is CVA, your potential future exposure, PFE, your Monte Carlo simulation models. Then you look at your risk assessment basis as well, the limit setting combines with quantitative analysis, your PD, LGD, expected loss, unexpected loss, economic capital, and qualitative judgment like your management experience, market outlook, risk appetite. So FRM loved this idea, model plus judgment. Then we need to understand the role of intuition, experience management, understand your cycles, your market fragility, your hidden correlation. This is especially relevant in your stress testing, your scenario design, your reverse stress testing. Then you look at your external influence, limits must satisfy your regulators, your rating agencies, your shareholders. Examples are large exposure limits under your Basel, your systematically important financial institutions, capital expectation. Then we have the business level limits beyond your firm-wide caps. Each business gets your sub-limit. This allows your efficient client execution, pre-approved flexibility, but always within your overall cap, right? So overall, when we try to connect it with the bigger picture, right, please understand everything we studied here links to your credit portfolio models. Limits reduce your correlation concentration. Economic capital limits your in economic capital limits constrain your unexpected loss. Stress testing limits tested under your extreme scenario. Basel III, large exposure framework, capital buffer, counterparty credit risk, exposure volatility, limit breach risk. And the big idea here is the credit risk management has three pillars: governance, who decide; delegation, who approves; limits, how much risk allowed, right? Model sits underneath all of this. Without governance, model are useless. Without limits, governance is meaningless. Without skill, delegation kind of fails, right? That's what we need to understand properly here, right? Then we come to your oversight, right? When we ask or we discuss your oversight, up to now, we have covered your policies, your limits, your delegation, your breaches. Now we look at your oversight, then we look at your reporting structure, then we look at your transaction risk parameters and the credit committee governance side. So this is where the FRM now shift from your risk modeling to risk leadership thinking. So when you look at your oversight, this is extremely powerful. Oversight is not macro management. It is your independent, informed supervision of risk taking. This has four pillars: independence, your strong qualifications, your closeness to the business, and open mind. So let's try to unpack them one by one. Independence means risk must not sit inside a profit center, right? Why? If risk manager reports to head of corporate lending or head of trading desk, the incentives are kind of misaligned, right? Pressure will be approve this deal. Pressure will be don't block the revenue, right? So proper structure is important. Risk manager should report to CRO. CRO should report to CEO. CRO should report to your direct access to board also. And this preserves your independence. This connects directly to your three lines of defense, your risk culture, your Basel governance expectation, very, very exam relevant. Then you talk about a strong qualification. Risk manager must understand your business model, must understand your transaction structure, must understand your incentive. They may attend your client meetings. Why? Because risk cannot operate blindly. They must challenge intelligently. This links to your structured credit risk, to counterparty credit risk, complex derivative exposure, weakly quantified risk manager leads to a governance failure. We need to understand closeness to the business, but not too close. This is suitable because if risk is too distant, right, they become kind of irrelevant, right? Business kind of bypasses them. If risk is too close, they lose objectivity. They become captured by the business. So balance is required. The concept is called constructive tension, right? This is one of the most important cultural concept in FRM, right? We talk about open mind. Risk managers are not your deal blockers. They must understand revenue goals. They must protect your capital. They must propose alternatives. This connect to your risk-adjusted pricing. This connect to your structuring with collateral. This connects to your covenant design, right? So good risk management enables your growth safely, right? That's what we need to understand here. Okay. Then we go to the practice question, right? Which of the following statement about risk managers reporting structure is most accurate, right? So to be most effective, risk manager should report to the business unit head. No, right? It compromises the independence, should not happen, right? Then to preserve the independence, risk manager should report directly to the CRO. Makes sense, right? Report directly to CRO. Risk manager should have dotted line reporting to both the CRO and business unit head. Again, create the conflict of interest. We don't want that, right? So to ensure effective risk governance, risk manager should report directly to the board of directors. Seems okay, right? But not practical operationally. The word directly is a concern here. Board handles strategic oversight, not your daily granular risk. So correct structure is risk manager should report to CRO. CRO should report to your CEO and the direct access to the board, risk committee, right? Risk manager should not go directly to the board, right? They can't go to granular thing, right? This ensures there is operational efficiency, governance independence. This connects back to your second line of defense framework, right? So answer here is B, right? That is what we are talking about. Again, this is what we are discussing. Risk managers should report to the CRO instead of business unit head to ensure they remain independent and free of business influence. CROs have influence at top of organization level, including your CEO and the risk committee. It would not be feasible for risk manager to report directly to the board, which deal with the board oversight of risk rather than your granular risk matters, right? Okay. So this is what we are looking at. And then we look at your transaction parameters, right? Transaction parameters. We are simplifying risk to its essence. Every credit sensitive transaction is defined by 3 dimensions: your amount, your credit quality, your length of exposure, tenor. This is elegant. Let's try to analyze it. Your amount of exposure, how big is the potential loss? This connects to your exposure default, your limit usage, your concentration. Higher amount means higher capital allocation. You look at the credit quality, how likely is the default. This is where your internal rating models come. The probability of default estimation comes, your credit scoring comes. This connects directly to your structural model, your reduced form model, your transition metrics. The model mentioned in Q3, the previous question, summarizing your credit worthiness, right, was for credit quality, right? Then we look at your length of exposure, which is tenor. How long are we exposed? Long tenor, greater uncertainty, higher capital requirement, greater correlation risk. This connect to your Basel maturity adjustment, your credit spread term structure, your migration risk. So overall, please understand the risk is a function of amount. Risk is a function of amount into probability into time. In simplified term, risk is multidimensional. These 3 parameters define or determine the approval level, the limit allocation, the pricing, the capital, right? Which we need to keep in mind. Okay. Once we have done this, we move to the next thing. Okay, fine. Which is this part. A firm recently developed a model to help summarize the creditworthiness of each of its counterparties. Which of the following risk parameters of a credit-sensitive transaction does this most likely represent, right? So basic idea is the firm develops model to summarize creditworthiness, right? So this represents your credit quality, right? Not your tenor, right? So it represents your credit quality, not tenor, not your exposure amount, not your maximum loss. This tests your ability to map your governance concept to your quantitative concept. Okay. So very, very easy, right? I don't think this is too difficult. Okay. So that is what we have here, right? Include credit quality, risk due to counterparty, the amount of exposure and length of exposure, which we have, right? Okay. All right. Then if you look at the next part, right, which is the credit committee, right? The last thing here in this chapter is that we have reached the final governance layer. The credit committee is where significant risk decisions are made collectively. You look at the role and composition, senior executives. Why senior? Because high risk deals impact your capital, decision affect your firm survival. Committee improves your large exposure, low rated counterparties, complex structure, clear governance, charter is required. Committee must have defined authority, defined threshold, defined kind of voting rules. Without your structure, there is chaos. This connects to your delegation matrices, your escalation frameworks, preparation and review. Transaction must be submitted well in advance without full risk package with the risk analysis attached. This ensures your thorough review, your no rushed approval. This links to your risk documentation, legal defensibility, your regulatory audits, your decision discipline. Effective committee approves some, defines some, declines some. If committee approves 100%, governance failure. Balanced judgment is the key, right? That is what we have. Then we have the cross-functional expertise. Committee includes your business, your risk, your legal, your compliance, your accounting. Why? Because risk is multidimensional. We said earlier also, right? Example is legal risk, your tax impact, your accounting treatment, your capital impact. This connects to your IFRS 9 expected loss, your regulatory capital, your conduct risk. Then we have your accountability and leadership. Members are decision makers, limited delegation, strong chairperson. If no consensus, have a vote. This ensures transparency. This ensures ownership. This ensures no ambiguity. Then we have your documentation. The minutes are recorded. Why? Because for regulatory review, there is a audit trail, there is a legal defense. This connects to your operation risk control, your supervisory inspection, your model validation review. Big picture here is what FRM is trying to teach you here is that this entire module shows you that credit risk management is not just about understanding the PDA models. not about PD estimation, probability of default estimation, not about loss given default modeling, not about your correlation structure. It is about understanding governance. It is about understanding structure as well. It is understanding your accountability, your escalation, your oversight, your discipline, right? Without these, even the perfect models fail. 2008 was not a model failure alone. It was a governance failure as well, right? So you need to have a comprehensive idea about these things as well, right? So we must understand three lines of defense. We must understand the policies. We must understand the limits, the delegation, the oversight, the credit committee, and under all of these, you have the quantitative models, the capital allocation, the stress testing, the economic capital, and FRM part 2 wants you to think like a chief risk officer, a senior risk officer, not just a model builder. That is why we have this chapter here in our syllabus. Okay. So that completes our this chapter, guys. Again, a very theoretical topic, right? You might have to remember a lot of stuff here, but that's how it is, right? This is very theoretical. If I have to give you a quick recap before I close this chapter, 2 modules, governance and risk management, and your credit risk guideline. First part is very easy. Governance and risk management, we have effective governance and risk-taking process and 3 lines of defense framework, which is very easy. A lot of it you have studied in FRM part 1, so I don't think that will be any issue. Credit risk guideline, here there is some kind of structure and there is some kind of difficulty, right? We're looking at principles, guidelines, creation and approval, then maintenance and control, the breaches and non-compliance, then skills, the limit, the oversight, the transaction parameter, and the credit committee. You have to go in detail of each. You have to understand how one thing differs from another. What are the finer points of each? What about the skills, approval, and delegation authority? How it's a layered kind of structure. All right, senior management involvement, escalation frameworks, limits, right? Oversight, what happens in oversight, what happens in credit committee, what are the transaction parameters, right? You have to understand that and you have to note down the finer points, right? So little bit of rote learning, you have to remember those things. Unless you remember those things, it is very difficult to score marks here, right? So unfortunately, right, we have such kind of chapters also, but this is how the risk management will work, right? They want you to understand from a framework perspective also, right? They don't just want to understand the modeling part, right? They want you to understand the framework, the structure, the audit, the logs, the overall architecture, so that it's not only about the model failure, it's also about the framework failure. It's also about the governance failure. So you need to understand the architecture of the governance, right? That's the whole objective of this chapter, right? I hope this makes sense, guys. We'll stop here and I'll see you in the next lecture, okay? All right, guys. Thank you.